All right, let's talk about emergency funds. For like forever, the rule has been to pile up a huge stack of cash, right? It's supposed to be the bedrock of your finances. But what if that bedrock is actually an anchor, just weighing you down? I know, it's a pretty bold question. We're all taught that having cash in the bank is the smartest, safest thing you can do. But today, we're going to flip that idea on its head and ask, is that safe money really doing you any favors?
So look, nobody's arguing you don't need a safety net. Of course you do. That's a given. The real question, the one that can change everything, is what that net should actually be made of. Should it just be a pile of cash sitting there Minosan, or could it be something more?
Okay, so you've basically got two different playbooks here. First, there's the cash pile. Think of it like a fortress. Super safe, nothing's getting in, but it's totally cut off from everything else you've got going on financially. Then you have the margin-backed fund. This is more like a power grid. Everything's connected, your investments are constantly working, and you can tap into that power when you need it. Totally different ways of thinking, right?
All right, let's put these two head to head. We're going to break down the pros and cons of each one.
So when you look at it this way, the trade-offs become super clear. The cash pile gives you that amazing sleep-at-night factor, but your return? A measly 4.5%. And that's before you even think about taxes and inflation eating it away. Now, the margin-backed fund, you get full market exposure. We're talking historical averages around 10%. But, and this is a big but, you're paying interest on that margin, maybe 8 or 9%, and you're taking on real market risk. Yeah, I'm talking about the dreaded margin call.
Okay, so we've covered the obvious costs, like paying interest. But there's a hidden cost here, a silent killer when it comes to the cash strategy. And that's opportunity cost. It's all the money your money could have been making if it wasn't just sitting there.
And this chart, it just lays it all out. Let's say you have 50 grand set aside. After 5 years in a high-yield savings account, you've got about 62,000. Hey, not too shabby. But what if you'd invested it instead? Even if we're conservative and say you got a 7% return, you'd be looking at over $70,000. That is a huge difference. So, what did that feeling of safety actually cost you? In just 5 years, it's almost 8 grand. Now think about that over 10 years, 20 years. That number gets absolutely massive. All right, enough with the theory. Let's get real. A crisis hits. You need $20,000 and you need it now. What happens? If you've got the cash pile, it's super simple. You just pull the money out of your account. Done. Your investments don't get touched. The only downside, now you got to start refilling that piggy bank all over again, bit by bit, out of your regular income. Now, with a margin loan, it's a totally different ballgame. You don't actually sell any of your investments. Instead, you borrow against them. This is key because it means your money stays in the market, hopefully still growing and compounding. Then you just pay back the loan whenever you can. But we got to be real here. This isn't a free lunch. The huge upside is you don't have to sell your stocks, especially if the market's down. That's awesome. But the downsides, they're serious. For one, interest starts adding up from day one. That 20 grand loan, it's going to cost you over $1,300 a year. And, maybe more importantly, you're taking on debt right when you're already in a stressful situation. That's a heavy psychological weight for a lot of people. So what if one way is too safe and the other is just too risky? Is there something in the middle, a best of both worlds situation? Well, that's where the hybrid approach comes in. And get this, there's some really interesting data from the Federal Reserve that backs this idea up. It turns out that for most little surprises, a lot of people are covered. This kind of suggests that having this gigantic 6 to 12-month cash fund might actually be overkill for a lot of us. Maybe a smaller 3-month buffer is all you really need for most things, and the rest could be put to work. And this is what that hybrid model looks like. You've got your fortress, a smaller pile of cash, say 3 months worth, for those quick, stress-free needs. Then the rest of it, what would have been months 4, 5, 6, and beyond, that goes into the power grid, your investments, where it can actually grow for you. And that's really the genius of it, right? It's all about balance. You get that instant cash for smaller problems, so you're not stressing about taking on debt for a car repair, but you're also capturing most of that potential growth by not having all your money just sitting around doing nothing. For a lot of folks, this is the sweet spot between being too safe and being too risky. But hold on, before we call this the perfect solution, there's a really important warning we need to talk about. The biggest problem with relying only on margin is that recessions and job losses tend to happen at the same time.
The market tanks right when you might lose your job, which is exactly when you need the money.
Yeah, this is the absolute nightmare scenario. Imagine the economy goes into a recession, the market crashes, and you lose your job. Then, to top it all off, your broker calls and says you have a margin call. You either have to find more cash or they're going to sell your stocks at rock bottom prices. This is the exact disaster that a cash buffer is supposed to save you from.
So let's bring it all together. A big cash pile? Super safe, but you're paying for that safety with lost growth. This could be great for someone like a freelancer whose income is all over the place. Relying just on margin, it's super powerful for growth, but it comes with real risk and stress. You'd need a rock-solid job and nerves of steel for that. The hybrid approach, it really does seem to strike a nice balance for most people. But at the end of the day, there's no one-size-fits-all answer. It's all about your personal tolerance for risk, what really lets you sleep at night. Which really brings us to the final question for you. The data, the pure numbers, they all point towards investing, but you can't put a price tag on peace of mind. That's not something you can calculate on a spreadsheet. So you have to ask yourself, what are you willing to pay for that feeling of security? And just a quick reminder, of course, this is all a thought exercise to explore some interesting ideas. It is absolutely not financial advice. Investing has risks, for sure. So please always talk to a qualified professional who can give you guidance that's tailored specifically for you.